Most people start trading with a demo account because it's free. And that's exactly why it doesn't work. Free practice costs you the one thing you can't get back: real emotional learning. You can't learn to manage fear with fake money. You can't learn to manage greed with fake money. You can't learn your actual edge with fake money because your psychology isn't engaged. So here's the paradox. The cheapest way to start trading isn't free. It's the smallest amount that makes you feel something. That threshold is different for everyone, but it's never zero. The magic number isn't about capital requirements. It's about the minimum amount that activates your real trading psychology. Find that number, and suddenly you're learning at 10 times speed for 1/10 the cost everyone else is paying. Look, I need to be honest with you right from the start. You're stuck in a waiting pattern. You think you need more money before you can start trading seriously. So you're saving, researching, preparing, but never actually trading. Or maybe worse, you started with whatever you had, lost it quickly, and now you believe you can't afford to trade. Both of these beliefs are prison cells. Both of them are keeping you exactly where you are. And the real pain, the thing that's actually hurting you, isn't lack of capital. It's lack of a framework that shows you how to start trading intelligently with almost nothing while still positioning yourself for significant gains. What you're about to receive in this video is a complete deconstruction of what it actually costs to start trading and what cheap really means. You're going to see why starting small isn't about accepting small results. It's about building disproportionate skill that scales infinitely once you add capital later. You're going to learn the psychology of what I call minimum viable trading, where you deploy just enough capital to engage your real emotions without risking catastrophic loss. And you're going to walk away from this with a concrete plan to start trading today, regardless of your current capital, in a way that teaches you faster and costs you less than conventional approaches. And here's what makes this different from every other how to start trading cheap video you've watched. Every other video focuses on finding low-cost brokers or small capital instruments. I'm not talking about that. I mean, those things are fine, but that's not what we're really solving here. I'm talking about reframing what you're actually buying when you fund a trading account. You're not buying lottery tickets. You're not buying a chance to get rich. You're buying psychological education under real market conditions, and that education can be purchased for $100 or $100,000. The difference is efficiency, not possibility. The myth that's been killing you is this: you need significant capital to trade successfully. But the truth is, you need significant capital to trade carelessly and survive. To trade intelligently, you need almost nothing, and intelligence always beats capital in the long run. Always. So let me tell you a story. Let me tell you about a trader who started with $217. Not 500, not 1,000, $217. It was literally everything he could scrape together after bills. Most people, if they looked at his situation, would have said, "That's not enough. Save more. Come back when you're ready. You're wasting your time." But he did something different. He did something really smart. He divided that $217 into 3 buckets mentally. $72 was what he called tuition. Money he expected to lose while learning the platform, testing his execution, figuring out his actual psychology under fire. He knew going in that this money was gone. It was the cost of admission. $100 was practice capital, money he'd use to execute his strategy for 30 trades, tracking everything obsessively. Every entry, every exit, every emotion, every thought. $45 was emergency reserve, untouched, unless he needed to prove something to himself about discipline, or unless he genuinely learned enough to justify deploying it. The first bucket disappeared in a week. Tuition paid. He learned how order types worked. He learned that his emotions were way more volatile than he expected. He learned that he couldn't just think about trading. He had to actually do it under pressure. $72 bought him that awareness. The second bucket lasted 3 weeks. He executed 30 trades, lost on 19 of them. But here's what's important. He learned exactly when his strategy worked and when it didn't. More importantly, he learned when he worked and when he didn't. He discovered he couldn't trade in the morning because his brain wasn't awake yet. He discovered he revenge traded after 2 losses in a row. Every single time. Like clockwork. He discovered his stop placement was emotional, not strategic. He'd set stops where he hoped the market would go, not where his strategy said they should be. All of that learning for $100. By the time he hit his emergency reserve, he was a completely different trader, not because he'd made money, he hadn't yet, but because he'd paid for psychological x-rays of himself. He knew his failure modes, he knew his triggers, he knew when he was reliable and when he wasn't. 6 months later, after adding saved income bit by bit, he was trading a $2,000 account profitably. A year later, $15,000. The $217 wasn't the constraint. His belief about what $217 could buy was the constraint. He thought it was too little to matter, but it turned out to be exactly enough to learn everything that mattered. Now, let me give you another way to see this. Imagine two traders start on the same day. Trader A has $25,000. He feels confident, ready, properly capitalized. He opens a professional platform with all the bells and whistles. He subscribes to multiple data feeds. He joins a trading room. He buys courses. He's serious. He starts trading with $500 position sizes because he can afford it. Why not? He's got the capital. His first bad trade, down $200. His reaction? That's okay. I have plenty of capital. This is just part of the process. His second bad trade, down $300. Still fine. I'm learning. This is tuition. 6 months later, he's down $8,000, and he still doesn't know what he's doing wrong because the losses never hurt enough to force real examination. He can afford to be wrong. The pain is diluted across this big cushion of capital, so he never actually looks in the mirror and asks the hard questions. He never has to because he's still got 17,000 left. He's got room to keep making the same mistakes. Trader B has $400. She opens the cheapest possible account that allows real money trading. She trades with $10 position sizes because that's all she can afford without blowing up in 2 trades. Her first bad trade, down $8. Her reaction, that hurt. Why did I do that? What was I thinking? She journals it. She analyzes it like a detective. She makes it mean something. Her second bad trade, down $6. She studies it like a crime scene. What went wrong? What was my state of mind? What did I miss? 6 months later, she's up $150 on her $400 account. That's only a 37% return. Nothing crazy, nothing to write home about, but she's gained something infinitely more valuable than $150. She knows exactly how she trades under stress. She's paid $250 in tuition, her losses, for a complete map of her psychology. She knows her edge. She knows her failure modes. She knows when she's reliable. And now, when she adds capital, and she will because she's saving, she's not starting over. She's not learning from scratch. She's scaling up a system that already works. She's scaling up a psychology that's already been tested. Who got the better education? Who paid less for more learning? The cheap account forced precision. The expensive account enabled sloppiness. This is the paradox nobody tells you about. Starting cheap isn't a handicap. It's a forcing function for excellence. So, what makes a cheap start intelligent versus just cheap? What are the actual principles that let you start with almost nothing and still position yourself to win big? Let me break this down for you because it's not about the dollar amount, it's about what you do with whatever you have. First principle, minimum viable trading. This is a concept I want you to really understand. What's the smallest amount of capital that activates your real trading psychology? Not demo, not paper trading. Real money that, if you lose it, you'll feel something. For some people, that number is $50. For others, it's $500. The number doesn't matter. What matters is that it's real enough to engage your fear, your greed, your hope, your discipline systems, all the things that actually determine whether you succeed or fail as a trader. Below that threshold, you're playing. You're practicing in a way that doesn't transfer to real trading. Above that threshold, you're learning. You're engaging the actual systems that need training. Here's why this matters so much. Most traders either start with too little, demo accounts where nothing feels real and they learn nothing transferable, or they start with too much capital they can't afford to lose, which creates paralysis and panic. Minimum viable trading finds the sweet spot. It's enough to make you care, not enough to destroy you. This is where real learning happens. You're not risking your rent money, but you're risking enough that your emotional systems activate. And those emotional systems, your fear response, your greed response, your hope, your discipline, those are what you're really learning to trade, not the market. The market doesn't change, you change. And you can only change when you're working with real emotional feedback. Second principle, capital efficiency versus capital size. Big accounts can absorb mistakes. Small accounts can't. This seems like a disadvantage on the surface, but it's actually a massive advantage in disguise. When you start with almost nothing, you're forced to be capital efficient. You can't afford to leave positions open hoping they come back. You can't afford to overtrade and rack up commissions. You can't afford to ignore risk management. Every decision has immediate consequences. One bad trade could take 10% of your account. That focuses the mind like nothing else. And this creates discipline that traders with big accounts never develop because they never have to. Think of it like learning to drive. If you learn to drive in a tank, you can be sloppy. Hit things, take corners too fast, it doesn't matter because the tank protects you. If you learn to drive a motorcycle, you develop precision immediately because sloppiness kills. There's no margin for error. Small accounts are motorcycles, big accounts are tanks. The motorcycle rider becomes skilled faster because the feedback loop is immediate and unforgiving. That skill, once you develop it, transfers to any vehicle. You can ride any bike, drive any car, because you learned precision from the beginning. But tank skills don't transfer to motorcycles. You see where I'm going with this? Start small, get skilled, then scale. Don't start big and hope you develop skill before you run out of capital. That's backwards. That's expensive. Third principle, the cost of ignorance versus the cost of knowledge. Here's a reframe that changes everything. You're going to pay for your trading education either way. There's no avoiding it. The only question is whether you pay for it with time and small amounts over a learning curve, or with large amounts and devastation in a very short period. Demo trading costs you time because you learn nothing transferable about your psychology. You can paper trade for years and still have no idea how you'll react when real money is on the line. Big account trading costs you large amounts because you're making $500 mistakes instead of $5 mistakes while learning the exact same lessons. The lesson, don't revenge trade after a loss. That's a lesson every trader has to learn. It costs you $15 when you're trading small. It costs you $1,500 when you're trading big. Same lesson, different tuition. You're learning the identical thing, you're just paying 100 times more for it if you learn it with big size. The cheapest path is actually the middle path. Small, real money trading, where each lesson costs you $5 to $20 instead of $200 to $2,000. You're buying the same education. You're learning the same psychological truths. You're just getting a 90% discount by learning with smaller size. Choose wisely. Be smart about what you're purchasing. Fourth principle, psychological bandwidth and position sizing. When you trade size that's too big for your account or for your psychology, you consume all your cognitive bandwidth managing fear. You can't think clearly. You can't execute your plan. You can't observe yourself. You're just in survival mode, trying not to blow up. When you trade size that's appropriate, where loss feels real but not catastrophic, you maintain cognitive bandwidth. You can think, you can observe yourself, you can learn, you can improve. The cheapest way to start trading is finding the position size where you're emotionally engaged but not overwhelmed. For most people, starting with $500 or less, that's positions where a loss costs you $5 to $15. That's enough to feel real. Not enough to trigger full survival mode where your prefrontal cortex shuts down and you're just reacting. In that zone, between boredom and panic, that's where all real learning happens. Find that zone and you'll learn faster than traders with 10 times your capital, who are either bored with tiny positions that mean nothing or terrified with large positions that mean everything. Okay, so you understand the principles: minimum viable trading, capital efficiency, the cost of knowledge, psychological bandwidth. But what are the actual steps? How do you implement this starting today with whatever you have? Let me break this down into something you can use immediately. Practice 1, the capital allocation formula. Whatever amount you're starting with, and I don't care if it's $200 or $2,000, divide it into 3 buckets. 30% is tuition. Expect to lose this while you figure out platform mechanics, order types, your actual behavior under stress. This isn't pessimism, it's realism. You're going to make mistakes. Budget for them. 50% is practice capital. This is for executing your strategy across at least 30 to 50 trades to gather statistically meaningful data. 20% is reserve, untouched unless you've proven consistent execution and need to prove something about scaling. This formula works whether you're starting with 200 or 2,000. It creates psychological structure and prevents the all-or-nothing mentality that kills accounts. You're not gambling with everything hoping to get lucky. You're systematically investing in your education with appropriate risk budgets for each phase. Practice 2, the minimum effective dose. Calculate your minimum effective dose for learning. Take your total capital and divide it by 50. That's roughly your position size per trade. If you have $500, you're trading $10 positions. If you have $1,000, you're trading $20 positions. This ensures you get 50 learning opportunities minimum before you're out of capital. 50 trades is enough to see patterns in your behavior, enough to test if your strategy actually has edge or if it's just random, enough to justify adding more capital or adjusting your approach. Fewer than 50 trades and you're just guessing. You don't have enough data. More than 50, and you're probably overtrading or risking so little that you're not learning anything because nothing feels real. 50 is the sweet spot for statistical significance in your own behavior patterns. Practice 3, the lesson log. This is the most important practice, and almost nobody does it. After every trade, win or lose, write 1 sentence. What did this trade teach me about me? Not about the market, about you. Did it teach you that you exit winners too early because you're afraid they'll turn into losers? Did it teach you that you hold losers too long because you can't admit you were wrong? Did it teach you that you trade better in the afternoon than the morning? That you chase FOMO setups when you're bored? That you're more disciplined after a loss than after a win? These psychological lessons are the actual education you're paying for. The profit and loss is secondary. If you extract the lesson from every trade, even losses become profitable because they teach you what to avoid next time. This practice transforms trading from gambling into education, and education always compounds. Always. The lessons you learn in trade 10 make trades 11 through 20 better. The lessons from those make trades 21 through 30 better. It's exponential if you're paying attention. And that's how you start trading cheap and still position yourself to win big. Not by hoping you get lucky with small size, but by using small size to build disproportionate skill that scales infinitely when you add capital. Let me bring this all together for you. You came here thinking you needed more money to start trading, or that starting cheap meant accepting small results forever. And what I've shown you is that cheap isn't about the dollar amount. It's about efficiency. It's about extracting maximum learning from minimum capital. It's about engaging your real psychology without risking catastrophic loss. You learned about minimum viable trading, finding the amount that activates your emotions without overwhelming them. You learned about capital efficiency and why small accounts force the discipline that big accounts never develop because they never have to. You learned that you're going to pay for your education either way, and paying with small amounts early is dramatically cheaper than paying with large amounts later when you still don't know what you're doing. And you learned about psychological bandwidth and finding the position size where you can actually learn instead of just trying to survive. You also got the practical framework. Divide your capital into tuition, practice, and reserve. Calculate your minimum effective dose, which is your capital divided by 50, and extract lessons from every single trade by asking what it taught you about yourself, not about the market. These aren't complex strategies, these aren't secret techniques. They're simple frameworks that work because they align with how learning actually happens under real market conditions. Starting cheap isn't settling, it's strategic. The trader who starts with $300 and learns precise execution is in a better position than the trader who starts with $30,000 and learns sloppy habits, because skill scales. Capital doesn't teach anything. Capital just amplifies whatever you already know how to do. If you know how to lose money efficiently, more capital just means you'll lose more money more efficiently. But if you know how to trade with precision, with discipline, with a tested edge, then capital becomes rocket fuel. It accelerates results without changing the underlying system. Skill can be built with almost nothing if you're intentional about it, if you're strategic. If you understand what you're actually purchasing with your trading capital, you're not buying hope, you're buying education. And education is the best investment you'll ever make. Here's what I want you to remember. Say this to yourself. Write it down. I don't need more money to become a trader. I need more clarity about what I'm buying with the money I have. I'm not buying lottery tickets. I'm not buying hope. I'm buying education under real market conditions. And that education can be purchased for the price of a dinner or the price of a car. The only difference is efficiency. I choose efficiency. I choose to learn fast and cheap rather than slow and expensive. My small account is not a limitation. It's a forcing function for excellence. And excellence, once built, scales infinitely. Let that settle in your mind. You're not waiting anymore. You're not saving until you're ready. You're starting now with whatever you have because you understand that readiness is built through action, not preparation. You don't get ready and then start. You start, and that's what makes you ready. That's how it works. That's how it's always worked. If this reframe landed, if you see now that starting cheap is actually strategic rather than settling, tell me in the comments, what's your starting number? What's your minimum viable trading amount? Is it $100? 50? 300? It doesn't matter what the number is. What matters is that you know it and you're willing to deploy it intentionally for learning. And what's the first lesson you're going to extract from your first trade? Your journey inspires others. When you share your number, even if it's $100, you give someone else permission to start with 50. That's how movements begin. That's how communities of real traders, not gamblers, but real students of the craft, that's how they form. And if you want more of this, frameworks that make trading accessible regardless of capital, psychology that actually works in real markets, wisdom that doesn't require you to be rich to be successful, subscribe. Not for me, for you. Because these reminders matter. This perspective matters. And 6 months from now, when you're trading a bigger account with skill instead of hope, you'll want to come back and remember that it all started with clarity, not capital. It started with understanding what you were actually building. You don't need more money to start trading. You need more understanding of what you're actually buying with whatever money you have. And now you have it. You have the framework, you have the principles, you have the practices. So go start today with whatever you have. $200, $150, it doesn't matter. What matters is that you start with intention, with structure, with a learning mindset instead of a gambling mindset. Because cheap isn't the problem. Waiting is the problem. Believing you need more before you can begin is the problem. That belief will keep you stuck for years while someone else with half your capital and twice your clarity is already 6 months ahead of you learning the lessons you're still preparing to learn. Don't let that be you. Start now, learn fast, build skill, then scale. That's the path. That's how you win. See you in the next one.